I see countless videos on YouTube talking about investing in dividend stocks. There is a ton of content about trying to build passive income through dividend stocks. Some YouTubers and even professional investors buy stocks just because they pay out a high dividend. One of the biggest investing mistakes I see young investors make is buying a stock just because it has a high dividend yield, or put more simply, pays out a lot of dividends relative to its share price. However, investing in stocks purely for a dividend is almost always an unwise thing to do for anyone who's trying to invest in stocks to build long-term wealth. In this video, we're going to listen to Warren Buffett describe why companies paying out a dividend can actually be a bad thing. Now, let's listen to what he has to say.
And Mr. Cray made the statement that his favorite American stock is Berkshire Hathaway. And one of the major reasons he stated was that Berkshire has never paid a dividend, as we all know, and consequently you had superior utilization of the extra cash. Now, if you extend that reasoning, could it also be a beneficial policy if Coca-Cola and Gillette stopped paying dividends and utilized the cash in other ways?
Well, it depends what they could use how they would utilize the cash, what they could use it for. Those are more focused enterprises than Berkshire, at least in terms of products. And they, I commend managements that have a wonderful business for utilizing cash in those wonderful businesses or in businesses that they understand and will also have wonderful economics, and for getting the rest of the money back to the shareholders. So Coca-Cola, in my book, is doing exactly the right thing with its cash when it uses all the cash that it can effectively in the business to expand in new markets and all of that sort of thing. But then beyond that, it pays a dividend which distributes cash to shareholders, and then it repurchases shares in a big way, which returns cash on a selective basis to shareholders, but in a way that benefits all of them. So you will benefit from us not paying dividends just as long as we can use every dollar we retain to produce more than a dollar of value and of market value over time. Whether we can continue doing that, how long we can continue doing that, I can't promise you, but that's the yardstick by which the decision is made. And that is the yardstick, I think, by which Coca-Cola is making the decision too, and I think that they deserve great credit for exercising the discipline to quit when they using cash when they run out of the opportunities to use it well, and then to further deploy it advantageously by repurchasing shares. I think one of the things I admire about my friend Bill Gates, he's got $4.5 billion of cash in Microsoft, and there are very few managements can stand having $4.5 billion of cash and not doing something unintelligent with it. So far, it's made sense for us to retain everything we earn, and I think it'll make sense for a while longer, but it may not make sense indefinitely.
In terms of not paying dividends, we don't pay dividends because we think we can turn every dollar we retain into more than a dollar of market value. I mean, the only reason for us to keep your money is if it becomes worth more by us keeping it than it would be worth if we gave it to you. And if we can create more than a dollar of market value for every dollar we keep, you're better off whether you want to take that dollar out by selling a little piece of your stock or whether you continue to leave it in. That's the test. If we come to the conclusion that we can't do that, and we could come to that conclusion sometime, then we should distribute it to you. The interesting thing is, we're in certain businesses, for example, See's Candy being one. We don't have a way to intelligently use all of the money that See's generates within the See's Candy Company. So if See's were a standalone company, it would pay very large dividends. Not because it just had some dividend paying policy. It would be simply because we wouldn't have a way of using, in this case, $30 million a year intelligently in expanding that business. The Buffalo News is the same way. We don't have a way of using money within that specific business intelligently to use the money that it generates. We hope that in the overall Berkshire Hathaway scheme of things, that we can intelligently use the money that the companies in aggregate generate for us. And we think so far we have, and we think the prospects are reasonably good that we can continue to do that. But dividend policy should really be determined by that criteria, also bearing in mind the possibilities of repurchase of stock too, but they should be determined by whether a dollar left in the business is worth more than to the shareholder than a dollar paid out. Someplace like Coca-Cola, if Coca-Cola had paid no dividends and simply repurchased shares and developed the bottling system and done the things that they have, the shareholders probably would have been even better off. They've been sensationally well off as it is, but they probably would have been even better off than they have been with the dividend policy they have had. And that's Gillette and Disney and companies of that sort that have got these terrific opportunities to use capital within the business or to repurchase shares of a company that simply can't be replaced. That usually is the best use of capital.
To truly appreciate what Warren Buffett is saying in this video, you have to understand why a company would even pay a dividend in the first place. Let's use Kroger, a company Warren Buffett owns a lot of stock in, as an example to demonstrate why a company would pay a dividend and why the decision to pay a dividend could actually be bad for long-term investors. Now, for those of you who don't know, Kroger is the United States' largest supermarket by revenue and the second largest general retailer. Kroger made nearly $2.6 billion in profit in 2020. Now, that's obviously quite a bit of money, so what exactly is a company supposed to do with all those profits? The first thing Kroger could do is reinvest some of those profits back in the business. This could be by fixing up stores that are getting old, or even expanding the business by opening up new locations. Both of these things would be considered capital expenditures. That's just a fancy accounting term for investing back into the operations of the business. After reinvesting back into the operations of the business, there are a few other things a company could do with any money that is left over. The company can pay dividends, which are simply cash payments shareholders receive from owning the stock. Kroger did that in 2020, paying out $534 million in dividends. This means that for every share someone owns in Kroger, they would have received 50 cents in dividends in 2020. This may not seem like a lot at first glance, but it is somewhat impressive when you consider Kroger stock was selling for around $30 a share at some point during 2020. The other thing Kroger could do with its extra money is repurchase shares. When a company repurchases shares, it decreases the number of shares outstanding and, as a result, makes each share of a company represent a larger ownership stake in the company. Kroger did that as well, repurchasing $1.3 billion worth of stock in 2020. So now that we have some background about why a company would choose to pay dividends, that raises the most important question in the video. Why can dividends actually be a bad thing for investors? Here are the two main reasons why dividends can actually be bad for a long-term investor. The first point is that sometimes companies pay out dividends instead of growing the business. By doing this, companies sacrifice the long-term health of the business for the short-term benefit paying a dividend. This is the main point Buffett was getting at in the earlier clip. Going back to our example of Kroger, it would have been a bad idea for Kroger to pay out a large dividend when it was a smaller company and growing rapidly. Instead of being paid out as a dividend, the money was better used in growing the business, expanding into new cities, and making the company more profitable over the long term. This applies to Amazon right now, another stock Warren Buffett's company, Berkshire Hathaway, owns. Right now, Amazon is growing rapidly, and it needs every dollar to be used to continue to expand, whether it is building new warehouses, hiring more people, or expanding Amazon Web Services. There are many attractive areas for Amazon to spend its money growing the business. Amazon should only start paying a dividend when the company has more cash than areas for the company to use that cash to generate high returns for investors. The second point, and something that really takes a while for new investors to understand, is that most companies can't maintain extremely high dividend payout levels. There is pressure on a company's management to always be raising the dividend the company pays out, despite changes in the underlying performance of the company. Sometimes, the dividend gets to such a high level that the company can no longer continue to pay the large dividend. These companies are commonly referred to as dividend traps. Naive investors will buy shares in the company because it has a really high dividend yield, only for the management of the company to cut the dividend substantially because the company doesn't have the ability to continue paying the dividend. This is what happened recently with AT&T. Some investors purchased the stock because the company's dividend yield was nearly 5 times that of the average S&P 500 company. Shortly after, the company cut its dividend in half, and the stock price plunged. Investors who bought the stock for the dividend lost far more money due to the stock price decline than from the few dividend payments they received.